Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Kevin Davitt, head of index options content at Nasdaq, to discuss the outsized impact that interest rates are having on the markets. Kevin, it's great to see you as always. Welcome back to Trade Talks. And interest rate expectations really have had an outsized influence on the markets, particularly the Nasdaq-100. But that has shifted over the past week. What do you see going on out there?
Well, I imagine there are quite a few people asking themselves what's going on out there given the more recent backdrop. So today that question was kind of enhanced by concerns around Credit Suisse. The short answer, at least from my perspective, is massive moves in the interest rate markets. That's been the case, as you sort of mentioned, for the better part of the past year, but this past week has been unusual. The visual on the screen plots the Fed funds curve at discrete dates throughout this calendar year. The points coincide with FOMC meetings, and the blue line shows where the Fed fund futures expected the market to be back on March 7th, just over a week ago. As you can hopefully see, the expectations a week ago was for terminal rates to top out around 5.7% in summer, and the market expected short-term rates to stay there throughout the calendar year. That curve now looks dramatically different. The orange line is a snapshot that I took from yesterday, and it shows expectations for about 2 more 25 basis point hikes, followed by cuts later this year. The catalyst is likely the uncertainty around the regional banking system and their efforts to quell systemic banking fears. Now, if you incorporated the full rates term structure, you are going to see a similar shift. Most dramatically, the move in the 2-year yield has been nothing short of extraordinary. A week ago, the 2-year yield was just over 5%. And last I looked today, it was around 3.85%. That is exceptional. So huge shift in interest rate futures markets over the past week. Big picture, the fact that the MOVE index, which measures forward vol expectations based on 10-year futures, looked elevated relative to equity vol measures like vol-Q and VIX. That kind of market or indication happened to be right. And the epicenter of macro vol continues to be rates focus, and I don't think that's likely to change anytime soon.
So we saw the influence on the Nasdaq-100 in the past year relative to the S&P 500 or the Dow Jones Industrial Average. It certainly did have an impact on the Nasdaq-100. Have we seen a reversal in terms of index performance?
I think that is potentially a really interesting question looking out to the rest of this year. So yes is the short answer. The longer answer depends on the time frame that you're analyzing. So in the short term, what I mean by that is over the past week where Silicon Valley Bank and other kind of associated names have raised market concerns, the Nasdaq 100, interestingly, has markedly outperformed relative to all other major US equity indices. Again, I'm looking at March 7th through end of day yesterday in the visual. The red and white candle plots the Nasdaq 100 over that past week, lower by less than 1%. By contrast, you have the S&Ps that are down right around 3%, a Dow off 3.7%, and the small cap Russell 2000 has really taken it on the chin. The small caps are off by more than 6% over that time frame. But when I step back and think about the makeup of those indices, it makes more sense to me. Small cap tends to be much more levered. The market has been rewarding strong balance sheet companies. And if you think about the financial positions of the likes of Apple, Microsoft, Amazon, and Google, Apple at the end of last year had something like 51 billion in cash on hand. Microsoft had about 100 billion. Small caps, by contrast, are much more dependent on the financing markets, and they're suffering in the current circumstances.
So, Kevin, you and I meet once a month, typically the Wednesday before monthly options expiration. What are you going to be keeping your eyes on between now and then? Because a month feels like a very long time in this current news cycle.
It sure does. Well put. And I look forward to this conversation every month, and the timing, I think, is strategic. So I'm going to focus a great deal of attention naturally on forward and realized vol measures. Like I mentioned a minute ago, I'm going to be keyed in on the MOVE index because it's felt like a leading measure given this macro backdrop. I'm going to, of course, incorporate vol-Q and other options-based measures. Like you said, there is a significant quarterly expiration this Friday. I think that you're already seeing some of those positions either being monetized or moved out in time. To me, it's going to be interesting to see if the kind of larger multi-month trading ranges are held after this Friday expiration. So I'd be talking about 11,000 on the downside in NDX and then 12,500 on the upside. The S&Ps are also in the middle of a kind of 3 to 6 month range. And then lastly, there's a Fed meeting next week. They're well aware that the financial plumbing is kind of coming under some pressure, and it's hard to believe that that wouldn't happen given the pace of the hikes that they took over the past year. So I wonder whether Powell and company will be able to sort of thread the needle with their statement and decision. We're going to get an updated look at the dot plot a week from now, and I'll certainly be curious to see how it looks and how the market reacts. And then one last thing, I'm going to be watching my Marquette basketball team on Friday. They have a really exciting group this year. I'm pumped for the NCAA tournament and St. Patrick's Day. Very few dull moments.
March is always the line of the month, that's for sure. Appreciate the insight as always, Kevin. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.